The Federal Reserve meets today, and many anticipate they will increase interest rates by another 3/4 of a percentage point, if not a full point.
And joining us now to talk more about it, local financial professional Ryan Wheelis from Allied Wealth to talk about another rate increase, what it will mean to consumers. Ryan, good morning. How you doing?
I am excellent. How about yourselves?
We are great. Thanks for being with us. So here we go again. The Fed meets today. It looks like they might raise interest rates. What do you think?
I think it's going to happen. We're looking at 0.75%, and I've heard rumblings to be as high as 1%. But I do think it's going to happen. We have all this stimulus money that came into the economy during the COVID pandemic, and as a result, a lot of people had a lot of money to buy things. And what's happened as well is the supply chain has kind of shut down or was shut down during that period. And so it's led to a reduced amount of products and services out there for people to buy. And when supply and demand laws kind of crash like this, if you will, prices go up, and we're all experiencing it. So you couple that with the energy policy with the current administration in the White House, and also just a lot of things in the economy are kind of overcooking. The Fed's raising these rates to try to slow things down and cool things down a little bit.
Ryan, some people think the Fed is pushing us into a recession. What's your take on that?
Well, I mean, that's kind of what they are trying to do, but you hear comments often in the news about a soft landing. So what they're trying to do is bring us to the brink of a recession, but then kind of when it gets to that point, start reducing rates and lowering rates and trying to speed things back up and get the economy going again. It's a chess match. It's a tough thing to do, and as the wise blind man says, we shall see.
I mean, is this one of the few ways that I guess economically they can attack inflation?
Well, it is the primary driver of reducing inflation, and the Fed's mandate is to keep inflation around 2.5%. And with the CPI index at 9.1 and still climbing, what they have to do is cool things down. So they're a long way off from their target inflation rate of about 2.5%, and they're working diligently to get us there. So to do that, their main driver or main tool in their toolbox, so to speak, is to be able to raise rates, and that's exactly what they're attempting to do.
Ryan, some are choosing to sell stocks now to minimize losses. Would you recommend that strategy?
Well, you know, I never want to sell stocks at a loss, right? Because how do you make money in the stock market? Well, you buy low and you sell high. So if you're thinking about selling now after the market turn down has already come, I think we're down about 20% year to date, you're probably a little bit too late to do that. So I would tell you to probably hold on. Don't panic. This too shall pass. And don't make any rash decisions about your portfolio. With the caveat of this, you can rebalance into things that do better in an inflationary environment, such as large cap stocks. Big companies do typically well during an inflationary environment. Real estate stocks could actually do well in an inflationary environment. And also things like commodities and gold and oil and that sort of thing could help buoy the stock losses in your portfolio.
Looking at this from a global perspective, we're experiencing obviously inflation growing here. It's very high in the United States. Interest rates are going up. How does that impact, I guess, the global economy, or maybe it's the flip? When we look at other countries, are they feeling the same impacts we are?
Well, look at the oil price, because the oil price directly impacts everybody, right? There's no escaping it, because every product that we consume got to us in some type of capacity using oil. For instance, you know, ship stuff into port, the stuff that, you know, gets into port, gets onto a truck, gets shipped. So those are just two oil factors right there that are impacting the global economy. And so everybody's kind of feeling the pain. It will continue for quite some time. It'll take about 2 to 3 years for the stuff to push through the economy and slow things down. And, you know, again, nobody's talking about the 800-pound gorilla in the room, and that's the supply chain. And that's impacting folks all around the world as well.
Ryan, what about folks who are ready to retire? Is this a good time to make that leap, or what are you seeing with your clients?
If you're ready to retire and you've got a good, solid plan and you've had that plan tested for runaway inflation, which you should do, by the way, folks, and your plan still has a long-term probability of success of 85% or better, I say go for it. Go enjoy your golden years. There's one thing you will never get back, and that's your time. So if you're ready to make your job optional and that's where you are, go do it. Go enjoy yourself. But make sure you've stress tested your retirement plan for things like inflation and runaway inflation, and also market turndowns as well. And that's something we do for our clients and our prospective clients at Allied Wealth often. And it's a great thing to have because you can go out into the world and retire and spend money with confidence.
Yeah, you don't want inflation sneaking up on you at a point when you can't earn any more money, and that's why it's always great to have a professional. You don't want that guesswork.
Yeah, don't use the bank of mattress, as we say. You don't get any return, and that's losing money to inflation while you sleep at night.
Right, it's just getting lower and lower. Nobody wants that. That's why we love to chat with you, Mr. Ryan Wheelis. Really appreciate your time once again today. Thanks.
Always a pleasure. Thanks so much for having me on. Be well.
See you soon.